Hello, everyone. Good morning, good afternoon, and good evening. My name is Ouyang. I'm a founder of YGT. I'm also Associate Director at the Asia Society. So welcome to our YGT talk number 7. Let me give you a little bit introduction about YGT. YGT is an initiative launched by Asia Society with 5 other global partners. So we select young green entrepreneurs globally every year and empower them to tackle climate and environment challenges via innovative ways. So now we have hundreds of young entrepreneurs across 40 countries. So about tonight, why we are here. So first of all, as you may know, both U.S. and China, they present a very strong and ambitious policy in climate change, SDG, and of course, ESG becomes so popular now. And a couple of weeks ago, YGT Global Partners New Energy Nexus published a report about Climate Fintech. So tonight, thanks to our partner, New Energy Nexus, we will have 3 parts for tonight's event. So first of all, we invited one of the authors of the report, Aaron from New Energy Nexus, to give us a presentation about the report. And then we will have a roundtable discussion about this report, and a little bit beyond, we will also discuss a little bit about future of ESG investing and startups. And then I will introduce our amazing panelists by then. And finally, we will have Q&A. So welcome to leave your questions during this event. You can leave your questions on Facebook, YouTube, and Bilibili. So let's start. Aaron, showtime.
Hi, everybody. Thank you all for joining us from all over the world. And thank you to the Asia Society and Young Green Tech for showcasing the report and having this very timely, important discussion today. I'm just going to share the screen real quick. So as been mentioned, we here at New Energy Nexus just released what's called the Climate Fintech report, exploring digital financial technology and decarbonization. And I just want to do a quick background on who we are. New Energy Nexus is a network of accelerators and funds which nurture clean energy entrepreneurship all around the world. You can see this is the team here who is focused on the climate fintech solutions, including my partners Andrew Chang and Yafu Zhao, who are both based in Shanghai. And then New Energy Nexus, just global coverage, started in California as the California Clean Energy Fund, and then expanded primarily in Asia to foster thematic accelerator programs in some of the countries that you see there. Just an example of one of these programs is the electric vehicle battery challenge that we run in South Korea with LG Chem and Hyundai Kia Motors. So just a little bit of scene setting. We have an enormous task ahead of us in shifting $3 trillion a year to clean energy solutions, into decarbonization. And you can see that there is a massive gap to make up still. While increasing on an annual basis, we're still hovering around $500 billion a year, and we need to get to this $2.5 to $3 trillion number. So the question is, how do we get there? What we're seeing now is this enormous shift in capital towards ESG, environmental social governance solutions, in particular into renewable energy. I like this comparison on the left. For those following the GameStop hype over the last few weeks and in the investing world, one of the most popular investment funds is this one at the top, which is called ARK Innovation Etf. Now, of course, it's performed very well over the last year, 160%. But if you look below at the solar ETF, it's outperformed even more so. And I think that just sort of goes to show how much money is pouring into ESG solutions. That's also shown by the graph on the right, where you see this massive uptick in 2020. And a lot of this is driven by policy, a lot of geopolitical tailwinds, announcements around decarbonization, Biden, the EU Green Deal, and of course, China's commitment to decarbonize by 2060. So our question and what we're exploring is, how can climate fintech be a piece of this puzzle? What puzzle pieces are being addressed on the policy side that are not being addressed on the technology side, and how do we dive into that intersection? So this research was originally commissioned by the Hewlett Foundation, and we spent the last year interviewing fintech experts, banks, institutions, all kinds of climate solutions and climate startups to draw an umbrella and paint a picture for where these solutions are. And so on the right side here, you see the 8 core chapters of our report: payments, banking, lending, and so on, and encourage you all to download it and take a look. So what is climate fintech? It's digital financial technology that catalyzes decarbonization. So one of the biggest takeaways from the report is that these innovations have an impact on citizens like ourselves, individuals, as well as large institutions, financial incumbents, and the way that we all move money from point A to point B. This is really the focus on the intermediaries that help move money from one place to another. Now, I realize this is a very busy slide, but this is in the report. And again, on the left, you have these 8 chapters. And then within each chapter, there's a breakdown of climate fintech business models. So to take investing on the left side, 4th down, you'll notice that the second business model over is portfolio construction wealth tech. And if you look at the color coding of blue and orange under that, you can code that to the applied technology that it's using on the right side: big data and artificial intelligence. So we're talking about ESG investing in data today. And actually, our survey of this landscape, there was more investing climate fintech solutions than any other category. Huge proliferation in portfolio construction, robo-advisories that are directing money into these ESG solutions. Another important learning there on the right side is that there is a noticeable proliferation of these solutions in Europe, followed by the U.S. and China third. What's interesting is that the solutions in China actually cover a much larger percentage of the population. An example is ant forest, which is used by many hundreds of millions of people every day. There is yet to be a climate fintech solution used in the States on that scale. So ESG investing, as discussed, is really sort of hitting its stride now. There's a study done by Make Money Matter, an entity in the UK, that investing in sustainable funds can have 27 times the impact than living a healthy or living a consumer conscious, sustainable lifestyle. An example of a platform out there which is helping individuals invest in ESG is Open Invest. There's a long list of other platforms out there which are using digital financial technology to move capital in these directions. And I'll just finish it off just to let you know we've now published this report, and we're excited to announce that we're actually building a Accelerator Program, launching that mid this year. And it will have activities in Europe, the US, and China. It's going to be a global program. And if you're interested in participating in one capacity or another, feel free to reach out. And with that, I'll pass it back to Vin.
Well, thanks, Aaron. Okay, so let's start our roundtable discussion. Before that, let me introduce our amazing panelists. So Aaron from New Energy Nexus, he is one of the authors of this report. We'll cover that part a lot. And by the way, New Energy Nexus, previously they are California Clean Energy Fund. So they are also one of the angel investor of Tesla. I really want to talk about that. Very jealous. Okay, so we will also have Cindy Hu from Prudential. Cindy is Portfolio Director of Impact and Responsible Investing. Cindy is East Coast based. Cindy, welcome.
Thank you, Bing.
Hi. We also have Vincent Bakker. Vincent is from Intoria Energy. He's a group controller. And also Vincent is our YGT Young Entrepreneur. He's a finalist of 2019. Vincent, welcome. Vincent is Singapore based. So you can tell we try very hard to build a team of very diverse angles. We have, when we talk about this topic, we have a researcher, we have an investor, we also have the entrepreneur. So let's start. My first question is to Aaron. Actually, we heard a lot about climate issues, and we also heard a lot about fintech. But how did you guys come up with the idea to combine the two things together to wrote this report about Climate Fintech, which is a little bit new to me?
Sure. Yeah, it's a good question. So much focus right now is on climate tech and the solutions that are involved with that terminology, often hard tech heavy. So looking at solar panel tracking technologies or the latest in battery storage. And fintech is often either overlooked or categorized entirely different because of its focus on moving money from point A to point B. And the reality is that many of these fintech intermediary solutions are now directly focused on carbon accounting, and how you can decarbonize by using capital and directing it into certain projects and solutions, while also divesting from problematic areas. So when we released the report, we were overwhelmed with feedback because so many people have been innovating in this space, but didn't really feel like they were part of a community. And so I think that's been really helpful to conceptualize this sort of umbrella and look at the solutions within. Okay,
great. So as I mentioned at the beginning of this event, so one big change, as a lot of us maybe already realize, that both U.S. and China, they show very positive and ambitious policy on climate change, carbon neutral, and SDG issues. So my question is specifically to Cindy and Aaron. So how will this kind of a change reshape the current ecosystem of ESG investing and business?
Cindy, do you want to take this one first?
Yeah, sure. So thank you. First of all, let me thank Aaron and New Energy Nexus for doing this research and report on this topic. This is an exciting area. And to thank YGT for organizing this roundtable for discussion. And for us, as an investor, Prudential Impact Investing is in making investments in different impact themes, including financial inclusion, education and workforce development, sustainability, affordable housing, and transformative developments. So you can see that we already have quite a lot of touch points to the topic of today. And like for what Aaron was talking about in the reports, we at least have direct interaction in 4 of the 8 sectors that you're working on. And from the policy perspective, from what we have seen in the impact investing world, government policies that are leaning towards a certain sector are important to draw private investments and development of an industry. So unrelated to the to the climate fintech sector, Prudential is also heavily invested in charter schools in the U.S. So the U.S. government issues treasury bonds on behalf of these charter schools, which provides subsidies for the interest payments of private investments. The Treasury AAA rating subsidies serves as significant de-risking tools to incentivize private capital to invest, and also for the charter school financing to outgrow the private investments and tap into the public bond market. So this is kind of like an example of how the government policies at a high level is a big driver for the development of a sector. Another example in the fintech sector is India's demonetization policy in 2016, which was originally aimed to tackle problems in India's cash circulation, but that also significantly accelerated the adoption of digital and mobile banking in India. So these are just a few observations that we've seen in our investments from a government policy perspective.
Aaron.
Yeah, just to follow that, Cindy works and represents a very important asset owner here in the States, and they're a great example of this sort of shift in the investment community and in the asset owner community to making these types of capital allocations. And maybe just to sort of zoom out and look at, the UN SDGs, the Sustainable Development Goals, and how those are now being measured and monitored and tracked against. And out of that has come the United Nations Principles of Responsible Investment, the PRI. And it's just great to see so many asset owners and investors sign on to those treaties, those net zero carbon agreements, and start to allocate their assets accordingly.
Yeah. Prudential is proud to be a signatory to the PRI, and also we are as another observation as the industry practitioner. We are really grateful that UN's coming up with the SDG. I think that has become an important kind of like outcome goals from a impact measurement and reporting perspectives. I think this is a industry standards that has been adopted by more and more people, as Aaron just mentioned. This was not possible like maybe just like 5 years ago. I think the industry has been working quite a lot to come up with the tools for the measurement and report of impact, but it's very difficult given the differences between all the different sectors, and the SDG creates a very good tool to combine things for different sectors, and but also having a focuses on the specific areas of each sector.
Great. I would like to switch to Vincent, because you both Cindy and Aaron give us a bird view, but Vincent, you're an entrepreneur, so you're more like a soldier on the battlefield, and you're based in Singapore, and your business covers a lot of Southeast Asia, East Asia. So what's happening there? What's your point of view of this?
So I think Southeast Asia and Latin America, where we're both active, are quite different from the US and China and Europe in two perspectives. I think the first major difference between that world and Southeast Asia or Latin America, the first one is the policies. The US, China, and Europe, all in their own very different ways, have taken very active policies, laws, rules, tax initiatives, all to promote a much more sustainable, carbon neutral, recycling, and all the other things. So there's a very large policy framework and a policy push. That is very much lacking in Southeast Asia. There's a lot of stuff that's still allowed. There's a lot of stuff that's not really governed for. Singapore has a carbon tax, but not at a value that would make any impact even on the biggest polluter. Although it's getting there. So that's the first major difference. There's not really a policy push. And the second one is, and that's probably also quite related to the first one, in Southeast Asia and Latin America being more developing nations, it's all about money. In Europe, where I'm from, there was this perception, and there still is, a push from companies. We know our customers are willing to pay a bit more as long as we give people an equal wage, as long as we don't pollute the rivers, as long as we use sustainable farming products, and what have you not. That trend is not there in Asia. It's all about money. Now, that's not necessarily a bad thing as of today, because in renewable energy, which is the kind of the sustainability sector where I'm most active in, the fact that solar is so much cheaper than oil and gas, and the fact that people are here quite entrepreneurial and that the business landscape is quite dynamic, actually helps. Vietnam has installed 9 gigawatts of solar panel last year. That's an enormous amount. The US, I think, has 260 gigawatt installed, so 9 might not sound as a lot, but Vietnam is much smaller and it's a developing nation. This is 1 year only. So that push for money, the fact that sustainable solutions are now finally being cheaper, is actually helping those countries to catch up to some extent.
Yeah, I think, Vincent, you just cover very interesting part when you're talking about the what's happening in a developing country and the developing country like Europe. So I have this question specifically to Cindy. So is there any proof that ESG investment can guarantee the investors a better or decent return? Because I'm very curious. Because if not, how can we make sure this is ESG investing will be a sustainable thing?
Yeah, we definitely, from an investor perspective, we believe in profit for purpose. That financial and impact returns are complementary to each other rather than mutually exclusive. We have seen that, like, for example, we oftentimes use Cambridge, they're like as benchmark for our investments, especially in the private equity sector. And we see that the impact investment sector funds typically have returns at least as well as the rest of the private equity sectors or venture capitals. So that's clearly encouraging kind of like proof of to what we believe, which is profit for purpose. But to achieve that, we also believe, and also from our experience of investing in the sector for decades, from the team's perspective, we are more and more adopting an overall approach of managing for impact, which goes through the whole life cycle of our impact investments, including the intentionality that is important guidance for us to seek for opportunities in the sectors that we want to invest in, and then to moving on to impact due diligence. So we do due diligence not only on the financial viabilities of an investment opportunity, but also the impact orientation of the projects or the sponsors. And once we actually get into the transaction, we also trying to make sure that we're value adding in the portfolio management process, and including also the impact measurement and reporting during portfolio management process. And at last, when we are exiting from investments, we're also trying to make sure, or at least make efforts in mission safeguarding to make sure that the impact generating practices and orientations are saved when the investments is moved on to the next owner. So I think these are kind of like the efforts that we're making to make sure that ESGs are also good financial investments.
Okay. Go, Aaron?
Yeah, just to follow that, I think so much of ESG is as an investment framework has become very respected as a way to mitigate risk. You know, I think if you're looking at the environmental consequences, the social consequences, and the governance consequences of each and every investment you're making, you're going to avoid a lot of different kinds of risks. And you know, there's plenty of studies that are now showing that investing using an ESG framework will outperform the wider market. I just had a fun excerpt to read to you all from the report. As Bill McKibben explained, and he's the founder of 350.org, you better hope that you weren't long investing in oil going into the COVID-19 pandemic, because you not only helped wreck the planet, you also lost your shirt. Indeed, the majority of ESG funds outperformed the wider market over the last 10 years.
Okay, I think that's very interesting, but I will grab Vincent, come back, say, I think this question to you will be very simple. Can you make money now?
Yes.
Okay, you satisfied as a ESG category entrepreneur?
Simple question, simple answer, Robin. Yeah, I think you're absolutely right. I would like to add a bit of a nuance here. I think a lot of dirty investments are still highly profitable, unfortunately. LNG prices are through the roof in Japan because of the cold winter. Finding a massive oil field is still a big boon, even at $40 per barrel. I think the main thing is about, and that's what you said before, right? The ESG as a risk mitigation framework. There's a lot of downward pressure. Coal plants, people are not investing in coal plants anymore. Now, of course, all the banks say, oh, you know, we're so concerned about the environment. That's why we decided not to invest in coal plants anymore. And they put it on the website with some nice smiling children. The reality is they're just really bad investments nowadays, because a coal plant needs an uptime of 70 or 80%. If it drops anything below it, the whole thing is just not worth it anymore. So the whole thing is, you don't want to have a coal plant anymore. It's a really bad investment. And 3 years ago or 4 years ago, a lot of people started, when smart banks started to announce that they would stop investing in coal power plants, and again with smiling children on the background, it was for the very same reason. They look at these coal power plants, they're not going to run more. We see all these panels being installed, they're going to run less. And I think this is an example that you can see throughout your entire portfolio. If you're very exposed to fossil fuels, is this method of fossil fuels still going to be a good investment in 5 or 10 years? Well, LNG in Japan probably will be there for a while. Coal trading is just not a good thing. And the same with on the other environmental aspects. If you have a company that is really doing very poor on its land use, is that company going to get away with it? Indonesia is really taking a lot of measures against deforestation. So if I look at my ESG framework, and one that Standard & Poor's, for instance, adapts, is looking at land use. Is this company a responsible land user? If you score bad in any of these ESG components, it might not immediately affect your profitability. But sometimes in the next 5 or 10 years, there might be consumer changes, policy changes, tax changes, all sorts of changes that has a lot of downward risk. And those with a proper ESG framework have the opposite. They have upside risk. A company that is extremely good for its neighbors, that is extremely good with its land use, it might not be as profitable today. But there's a lot of upward pressure the moment the market starts or the policy starts really putting a dollar value on those principles.
Yeah, I think your observation echo a lot of information I read. We'll get back there later, but I think there's another very interesting point. Aaron, so in your report, it says that Europe is doing much better on ESG compared with US and China, even though US China are two biggest, much bigger market and much stronger VC and startup environment atmosphere in general. So my question is, if we want to nurture a robust ESG environment, what are the takeaways from the European story?
That's a great question, and there's definitely a lot of learnings from Europe that could be applied to other regions. Obviously, the Paris Climate Accords set the tone there, but there have been lots of sustainable finance work and foundations built long before that. I think that one of the simplest takeaways is the EU taxonomy, this attempt to basically agree that 2 + 2 = 4, and that this way of interpreting data should be uniform between different countries. And sort of drilling down into the technical, the units, what nationally determined contributions is a term from the Paris Accord you have to adhere to. In what sort of carbon accounting framework are you using as a country, and then as states, and then as industries? And so that all of the data filters up and everyone is on the same page. The attempt to get on the same page and use taxonomies has been quite challenging here in the United States. And so I think that getting that everyone speaking the same language is going to really help with measurement, and then of course with reinforcement.
Yeah, great. So
I can on that too. So I think what Aaron pointed out in the report about like the advanced status of Europeans in comparison to US and China, I think that is also consistent with our observation in the broader impact investing sector. Many European countries, they have their own what they call development financial institutions, who are quasi government agencies, who have the mandate of investing the country's public money actually to drive developments and generate impact. They are also active in making impact investments in emerging markets such as Africa, South Asia, and Latin America, and drive the developments of, like we have seen them clearly driving the development of fintech in these areas. And also we have also observed that in both public and private sectors, Europe's pension funds are active capital in ESG and impact investing. I think in both of these areas, they're definitely in a much more active and advanced position comparing to the US and China.
Yeah, I just want to echo what Cindy just said. So the emerging market is also sometimes surprise us. For example, last year, when we call for application, we received around 15 applications from Africa. So we were so surprised by how robust the people and how people care about this topic. And more importantly, we saw a lot of young African people. They're doing this. They're really hands-on. They set up their startups and they do a lot of clean energy, electricity, renewable energy things. So, and agriculture. So I think that's a very interesting thing for us to maybe in future to dive in. But I want to also move back to what Vincent mentioned before. And I think that's also a lot of people argue, say, when we are talking about ESG, you cannot just simply say, okay, what's the annual return? You have to look at this thing as a long-term issue. Like you have to cross like 10 years or even longer. So actually, that's very interesting about generational thing. There is a report actually shared by Aaron before. I think that's very interesting. It's by Bloomberg. That's a report by in this January. It says globally, 69% of people under 18 years old believe climate change is an emergency, compared with 58% of those older than 60, according to a survey of 1.2 million people across 50 countries by UNDP and Oxford. So my question is, let me ask Cindy first. Is this true? Because you have been getting involved in this kind of a thing for pretty long. If so, will this kind of a generational difference make your investment easier?
Yes, I think that's definitely what we have seen in the more general sector of ESG, like investments, both in the like retirement fund perspective and also in our private sector and investments. So we have clearly seen like not like crowdfunding, but in the retirement funds, like companies, even like Prudential, we are more and more focusing on the ESG conscious kind of funds, which are drawing a lot of attention and interests from younger generations, I would say, when it comes to their investment choice. So this is what we have seen, not from the impact investment perspective, but more general from the insurance and retirement sector.
Yeah, so I would like Vincent to share some personal story. I think you're a good example of this kind of change, because previously you worked for the big oil company, but you quit and you turn yourself into a startup entrepreneur. So I want to ask, say, what did make you choose this tougher life, Vincent?
Yeah. So I have to do penance for my sins of 9 years of oil and gas. I think the big change is when I finished university. Of course, there was a lot of talk about the carbon impact and the global warming. And I think European oil managers in that sense are very, very different from other oil managers because within Shell, they're already looking at environmental solutions, and there was already carbon accounting. And Shell was one of the first companies that would, in their investment proposals, include a price for carbon, recognizing that not just that it's a cost, but also that it might, like a cost on the planet, but also recognizing that it actually might at some point become a real cost in dollars out. As companies adopt a carbon tax, and that has been an investment criteria for quite some time until they even increased the game and looking at the general carbon intensity, where certain projects were dropped simply because it's too carbon intensive. We can't do this. We just should not be doing this project. So in that sense, European oil majors were always a bit more ahead than others. I think what made me change personally was a few things. I think the realization that global warming is not a few more centimeters of sea in 2 centuries, but that it's really a few more degrees. And that is not just about 1 or 2 degrees, because, okay, in Singapore, that makes a lot of difference as it gets hotter and hotter. But in the Netherlands, it's between -5 and +20. Who cares if it's 1 or 2 degrees? Until you see the devastating effect on the oceans, the huge typhoons that you get in Philippines because for 1 or 2 degrees. So realizing that that's actually such a big change, I realized I actually don't want to work in oil and gas anymore. I want to work in renewable energy. I understand energy. It's something I've been doing. I understand energy investments. How can I apply those skills in this new industry? So then I was looking for an opportunity because I'm a finance guy. I'm an investment guy. I believe in the power of the markets. So that's why I looked, okay, how can I apply those skills that I applied in oil M&A, in oil projects, in negotiation on gas projects? How can I apply that? And that's why I started a digital platform to basically connect investors that want to go into renewables and renewable energy projects.
Yeah. Okay. Good. So I think this generational change topic also has been covered by the report. So I want to ask Aaron. I don't want to romanticize the whole thing. For the long term, investors will realize, say, hey, ESG is a good return, good business investment, and for the long term, we will have more Vincent to dive into this industry category. But my question is about now. So what we can say for now is this kind of change. I mean, people's behavior, people's mindset is big enough for us to claim, say we are moving to a new age of ESG, or it's too early?
It's a good question. And I guess coming back to the generational fintech piece of it too, when everything is right here on your phone, especially as a young child, you're exposed to a lot more information. The ability to do something is a couple of pushes on your phone versus, going out into the world. And I think that's been acutely realized during this pandemic. People are stuck inside, and the power of technology in moving funds, but also educating, I think goes hand in hand now. And so that differential that you mentioned, whether it was 60-something% of people under the age of 18 think that climate change is a crisis, where there's a 10-point differential there with people over the age of 60. I think that all of these forces combined are going to allow for people to use these technologies for better, right? You think about neobanks, they have no branches, there's no physical locations. And so the ability to move money is just done at home or on your phone. And if people are also getting an education around the climate crisis, how they can spend in a more sustainable fashion, how they can plug a tool onto their credit card activity and reduce their carbon footprint and spend less money, it's the alignment of these incentives that start to become powerful and that start to engage a wide swath of the world population. So we think that the use of these digital financial tools is going to become more and more utilized by people, especially as the incentive structure becomes irresistible, both from an economic and from an ethical standpoint.
Great. So let's move the last part of our roundtable. I want to discuss a little bit more about the challenges and the problems. So I want to open this question to all of you. Do you think we need a clear standard for ESG? Let me give you an example why I asked this question. So a couple months ago, our team did some research about ESG, and very interestingly, we found some ESG ETF. In their portfolio, there are even a lot of liquor company. So we're quite confused, say, what is ESG, right? And now we're talking something like greenwashing. So what's your opinions? Anyone?
Yeah, it reminds me of something that happened last year. I saw the same problem. I saw that there was Royal Caribbean Cruise Lines was being held in something called the Redwood Fund. And I said, well, hang on a second. How can you have, this type of company where the cruise ships have such a damaging impact on the environment, and yet you're categorizing it as a Redwood Fund? And I think that there continues to be that problem across a lot of ESG funds. They're getting credit for another aspect of their business, maybe the S, social, maybe they're hiring people from diverse backgrounds or have gender equality, and they're scoring really high on the S, but the E, the environment score, is really low. But for some reason that passes the threshold that's acceptable to be included in this investment. So I think we just need better taxonomy, transparency around some of these scores. If you want to have that kind of information available, it should be available to you. You should be able to know that you are investing in Royal Caribbean not because of its environmental record, but because of its gender equality record. And I think that the access to information and the uniformity is still a bit of a mess and needs to be cleaned up over the next couple of years, so more people are educated in their decision making.
Yeah. Cindy? Yeah.
Sure. So I want to get back to the definition of climate fintech that Aaron put in the report. It's the use of financial, it's the use of digital financial technology for the purpose of decarbonization. So here, I think this ties very well to the first item that I was talking about in management for impact. Intentionality is the whole thing here. So you do need to start with what you want to achieve. And then also in terms of like identifying and stop greenwashing, I want to I totally agree with what Aaron was talking about. I think industry standards and regulatory requirements is very important here. It is not what you claim, but what you do to comply to all of these industry standards that matters. So I think intentionality and also the industry standards are key to avoid greenwash, but actually making good decisions and investments in the sectors.
Okay, great.
Yeah, the confusion about ESG is a very interesting one. When in my previous company, which was a startup, and we were pitching in front of investors in Asia, in general, people were, but we're actually looking at impact investment. And I said, well, we do environmental impact. Yeah, okay. No, I mean impact. Here in Southeast Asia, where the environment is less of an issue and governance even so, impact investors are often really looking for social impact. Getting communities out of poverty, schooling, healthcare, helping disadvantaged community, indigenous tribes. So that is really the focus of ESG. So maybe they, to kind of turn your point around a bit, Aaron, they might be surprised to invest in a solar panel company, while the company does absolutely nothing for local neighborhoods. So it's a bit of a nuance on ESG. And you're very right. We need to be clear what's in there, because ESG has 3 letters, environment being one of them. I think it's difficult to come to a single standard. And yeah, should Royal Caribbean be in there? I don't know. I also would hesitate to call any cruise liner a green company, and it sounds very contradictory to have it in an ESG portfolio. Somebody that basically is ruining Venice every time they roll in. It brings me back to a discussion that there was in the markets about 10 years ago when Shell was removed from the MSCI sustainability or the FTSE sustainable investments. Because a lot of environmentalists say, how can you have an oil company in a sustainable index? It's ridiculous. But the argument at that point was, which I can kind of also understand, was, well, yes, it's an oil company, but this is in the top 10% of all the oil companies. And then you can say it's not such a bad thing anymore, because if companies are setting a sort of golden standard within an industry, maybe the other companies are trying to catch up. So it's almost a philosophical question. Do you want to, out of principle, not invest in coal? Well, maybe I don't. Or do I want all the coal companies to have a certain standard? I don't know which one is right. I think for coal, we don't need coal anymore. We should stop it. But last time I checked, whenever my food is shipped in from Australia, I don't think those boats can go on battery. So whilst we need oil and gas, maybe we should just have a certain ESG standard as a minimum standard and promote that. And that might be the same with greenwashing. If everybody's greenwashing, okay, that's in principle not such a good thing. But it does raise the bar for everybody. Everybody has to at least set a bit of a statement. And as the market will scrutinize those claims, the real greenwashing will fall off, and the bar will get set higher, and higher. So that's my So I'm a bit conflicted whether Royal Caribbean should be in there or not.
Yeah, I agree. It's all relative, right? But and maybe, in that framework, ESG is sort of the first step. It's all it really is saying is that you care about something, whether that's environmental, social governance. There is some consideration into your ethical investment decision making, and then of course there is this spectrum where the further along you go, it's more specified. You move from ESG to actual impact investing, which is a lot more specific, directed, focused, and then from there, what kind of impact is it? Is it decarbonization investing, or is it gender parity impact investing? So ESG, I think, is just the sort of the first step in a long journey of voting with your dollars. And I think as ESG becomes more of a base level, you will see more proliferation in these further along the spectrum.
Great. I think we can talk for days and nights about this question. Let's quickly move to Q&A. We're running out of time, but I think there are a lot of questions. Let me go through this question list here. Actually, the first question, I jumped the gun. I already asked. It's talking about the standards and how you measure the ESG. And okay, there is a question. It says, not sure if you have paid attention to the Chinese market. Recently, more and more regulations are coming up towards ESG investing and sustainability in general. How do your evaluations such influence to the global? I think, Aaron, your report, half of that covers China. Would you say something about this?
Yes, although I wish I had my Chinese colleagues on the phone with me because they know the specifics better than I do. But definitely there has been incredible momentum around this issue in the last 5 years. I mean, China is the #1 manufacturer of solar panels. They are the #1 installer of renewable energy by capacity. So, I think that they're enormously important and have the potential from a central government to accelerate these efforts. I also know that in their most recent 14th 5-year plan, there are specific megawatt goals that are to be met from an installation standpoint. And of course, this sort of overarching announcement by President Xi to decarbonize by 2060, whether they hit incremental goals along that journey has yet to be seen. But I think there is reason to be encouraged.
Actually, I just want to follow up this question. I think China, for the recent couple couple of years, especially like say recent 5 years, their policy towards ESG and this kind of issues are quite consistent to me. But I want to discuss the U.S. Joe Biden. I mean, the new government they're coming up with a big turns, big change of the previous government. So I would ask, following this question, how do you think about the current U.S.? Well, we expecting a very big change of the ESG in U.S. Will we have a big booming soon under the new government?
My personal opinion is that yes, and I think a lot of people working in this industry are somewhat pleasantly surprised, encouraged by how aggressive some of the action has been, despite not having a clear majority in the Senate here. There are sizable plans to install 500,000 charging stations, for example. And if there is a way to pass this Green New Deal in some capacity, I think you will see sort of a decarbonization renaissance here in the United States.
Okay. I think there is another question actually we discussed before a lot, especially when we're talking about the booming. Let's look back the history. Around 2005, we also saw, the boom and the failure of clean tech. So what's different now? Is it same or is it totally different? Should we be cautious now? I mean, mainly we're talking about U.S. now.
I want to let others answer as well. So you tell me.
Maybe Cindy, how do you feel? It's just a repeat of a history or totally something different now?
My work is less related to the E side, but more to the S side. But from what I've seen from the social investment side, as I mentioned earlier, at least from the measurement perspective, I think it is a lot more clear now. I think the policy and the measurement from SDG or the other kind of like more from the output perspective, it's a lot easier for practitioner. Clearly from the volumes perspective, I will leave it to Aaron to answer specifically for the climate and environmental side of the work. But for the total impact investments, it's a pretty steep slope of increasing investments in the sector. So I would say it's definitely moving in the right direction comparing to 10 years ago or 15 years ago.
Just to quickly add on a climate bit, I think the difference this time around is simple economics. I think the International Energy Agency clearly came out and stated that the cost to produce electricity per megawatt hour is half the cost of coal than it is to solar. So even if you are not a huge advocate for renewable energy, if you care about simple economics, it's a pretty simple decision.
Great. Okay. Thank you all for joining us. And I think we had a very amazing discussion. So let me have a couple final words. So we will kick off our COFO application YGT 2021 around March, April. So if you're interested, if you're young entrepreneur in this category, I mean ESG sustainability, like Vincent, please follow us. You can see from the screen. You can find us in LinkedIn, Twitter, and we also have a website, younggreentech.net. It's a Chinese and English bilingual website. And if you are an investor, researcher, if you are interested about this topic, also please stay in touch, and we will see you soon. Thank you so much, and have a good day, everybody.
Thank you. Appreciate it. Take care.
Bye.
Good night.
Bye.
Good day too.